If I have invested rupees 1000 in each and every share in share market 5 years before, what would be my profit or loss as per today?
If you had invested 1,000 in every NSE listed share 5 years ago, around May 2021, and held them until today, May 2026, your result would likely be total invested, about 20 to 22 lakh. NSE had roughly 2,200 listed companies in 2021. Today's estimated value, roughly 35 to 45 lakh. Estimated profit, around 15 to 23 lakh. Approximate return, 70 to 110% overall in 5 years. Why this happened? Indian markets rose strongly after the COVID recovery. Many small and mid-cap stocks became multi-baggers. New IPO and tech stocks also boosted overall market capitalization. But there are important realities. 1. Some stocks would have gone to near zero. 2. Some companies got delisted or merged. 3. Many shares gave huge returns, 5x, 20x. 4. Equal investment in all stocks behaves differently from investing only in indices like Nifty 50. For comparison, 1 lakh invested in the Nifty 50 around May 2021 would be worth roughly 1.9 to 2.1 lakh today. Small cap indices performed even better during this period. So your 1,000 in every stock strategy would probably have beaten the broader market because tiny companies had explosive growth. A rough simplified example. Category, estimate. Stocks bought 2,100. Investment per stock 1,000. Total investment 21,000. Current value 40,000. Net profit 19,000. This is only an estimate because calculating the exact amount requires historical stock lists, split bonus adjustments, delisted companies, dividends, mergers, and exact purchase dates. If you want, I can also estimate best case scenario, top performing stocks, worst case scenario, or compare with investing only in Nifty 50, Nifty Midcap 100, Nifty Small Cap 250.
What would be the best strategy before 5 years which makes me more profitable as I invested 1000 rupees in each and every stock? What would be the best thing I should do instead of that before 5 years?
If your goal 5 years ago was maximum profit with reasonable risk, investing 1,000 in every stock was actually not the best strategy. It gave you diversification, but also forced you to buy weak companies, loss-making businesses, penny stocks, and dead stocks. A better strategy in 2021 would have been to concentrate on the strongest trends of the next 5 years. Here's what would probably have worked best in India from 2021 2026. Number 1. Best overall strategy, quality plus growth. Instead of 2,000 stocks, invest in 20 to 30 high quality companies with strong profit growth, low debt, and long term sectors. The sectors that exploded after 2021 were banking, defense, railways, power, capital goods, manufacturing, PSUs, AI tech services. Examples of stocks that massively outperformed: Tata Motors, HAL, Bharat Electronics, RVNL, Suzlon Energy, State Bank of India. Some of these gave 3x, 5x, even 10x plus returns. Number 2. The most profitable simple strategy. If someone had done this in 2021, put 40% in Nifty 50, 40% in small caps, 20% in emerging sectors, they would likely outperform buy everything. Because winners grow much bigger, losers don't dilute returns as much. Number 3. What probably would have made the most money? The highest return realistic strategy. Concentrated multi-bagger investing. Example, pick 10 strong future themes, invest heavily, hold for 5 years without panic selling. Themes that exploded: defense, railways, EVs, renewables, PSUs, manufacturing. This could have turned 20 lakh to 1 crore plus in some cases, but risk is much higher and stock selection matters hugely. Number 4. What was the safest great strategy? If you wanted strong profits with low stress, sip into index funds. Example, Nifty 50 Index Fund, Nifty Next 50, small cap mutual funds. Benefits, no research needed, low risk, strong long-term compounding. Historically, this beats most retail investors. Number 5. What you should avoid. Your buy every stock method includes fraud companies, zombie companies, zero growth firms, shell businesses. In stock markets, open quote, a few great companies create most wealth, close quote, so owning everything reduces the impact of the biggest winners. If I had to design the ideal 2021 portfolio example, category, allocation. Nifty 50 Index 35%, small cap fund 25%, defense railways PSU stocks, cash for opportunities 15%. That probably would have produced very high returns, lower risk, better compounding than all stocks equally. The biggest lesson in the stock market: diversification protects wealth. Concentration creates wealth. The best investors usually diversify enough to survive, but concentrate enough to grow rich.
What would be the best strategy for upcoming 5 years? If I invest today, minimum amount of rupees 1000 in each share, or I could have the limit of rupees 10,000, just investing for a one time investment. What would be the best 20 to 10 shares, 10 to 20 shares, which helps me to grow my 10,000 rupees into max, based on the Indian history, upgoing war situations, what are the upcoming fields or the youth generation developmenting, what modern society needs, basically.
If you are investing today for the next 5 years, 2026 to 2031, and your goal is to turn 10,000 into the maximum possible amount with a one-time investment, then the smartest strategy is don't buy every stock. Don't chase hype alone. Buy sectors that society must depend on in the future. The biggest wealth in markets usually comes from 1. Government spending, 2. Technology shifts, 3. War geopolitics, 4. Youth behavior changes, 5. Energy transitions. Right now, India is entering a phase similar to China manufacturing boom, US tech expansion, and military industrial growth. The strongest long-term themes appear to be the 7 biggest future themes, 2026 to 2031. 1. Defense and aerospace. Why? Global tensions rising, India reducing imports, export opportunities growing, drone warfare increasing. Strong candidates. HAL, Bharat Electronics, Bharat Dynamics, data patterns. This sector is strongly supported by Make in India and defense exports. Number 2, power plus renewable energy. Why? AI data centers need electricity, EV charging growth, solar and storage demand exploding, India targeting massive renewable expansion. Strong candidates: NTPC, Tata Power, JSW Energy, Suzlon Energy. Renewables and power are repeatedly identified as major long-term growth sectors. Number 3, manufacturing plus semiconductors. Why? China plus one strategy. India wants local electronics manufacturing, semiconductor push, mobile and AI hardware demand. Strong candidates: Dixon Technologies, Keynes Technology, CG Power. India's semiconductor and electronics ecosystem is expected to grow rapidly through government incentives. Number 4, railways infrastructure. Why? India is building aggressively, freight corridors, smart cities, logistics modernization. Strong candidates: RVNL, IRFC, Larsen and Toubro. Infrastructure and railways continue to benefit from government capex spending. Number 5, Banking plus financial services. Why? India is still underpenetrated financially, credit growth rising, digital payments booming. Strong candidates. HDFC Bank, State Bank of India, Bajaj Finance Banking remains a core long-term growth engine. Number 6. AI plus data centers, Digital India. Why? AI demand exploding globally. Cloud infrastructure expanding, youth moving fully digital. Strong candidates. Reliance Industries, Infosys, Persistent Systems, AI, cloud, cybersecurity, and digital infrastructure are expected to keep growing strongly. Number 7. Healthcare's pharma. Why? Aging population, lifestyle diseases, medical exports, biotech growth. Strong candidates. Sun Pharma, Apollo Hospitals, Cipla Healthcare continues to have stable structural demand. If you have only 10,000, then do not spread into 20 stocks. That becomes too diluted. Instead, choose 5 to 8 high conviction stocks. Invest 1,000 to 2,000 each. Hold for 5 years without panic. A balanced, aggressive 2026 portfolio, sector example, defense, HAL, renewables, Tata Power, manufacturing, Dixon, railways, RVNL, banking, SBI, AI tech, persistent systems, infrastructure, L&T, highest risk, highest reward. These could become multi-baggers if India's growth story continues. Suzlon Energy, RVNL, Keynes Technology, data patterns. But volatility will also be high. What modern society will need most? The future is likely to revolve around energy, security, AI, chips, data, healthcare, automation, infrastructure. That's where the biggest money usually flows, and markets follow where money flows.
If I could increase the amount, what amount should I increase and which are the best stocks should I buy? List them category wise and price wise and the interest I could gain or how many stocks I could buy or how much amount should I invest in that share.
If you can increase your investment amount, the best approach is usually keep 70% in strong compounder companies, safer long term growth, keep 30% in high growth multi bagger opportunities, higher risk, higher reward. For a 5-year one time investment, a very practical target is investment amount, suggested strategy 10,000, 5 to 6 stocks, 25,000, 8 to 10 stocks, 50,000, 10 to 12 stocks, 1,000, 12 to 15 stocks. Beyond that, adding too many stocks reduces growth potential. Stag best 2026 to 2031 portfolio, balanced plus aggressive. Number 1, defense sector, highest long-term conviction, approx price 4,500 to 5,500, suggested amount 10,000 to 20,000, potential 2x to 4x in 5 years. Strong due to fighter aircraft, drones, exports, government support. Bharat Electronics, approx price 250, 350, suggested amount 5,000 to 15,000, potential 2x to 3x. Good because radar, electronics warfare, missile systems. Number 2, renewable energy plus power. Tata Power, approx price 350 to 500, suggested amount 5,000, 10,000, potential 2x to 3x. India needs huge electricity expansion. Suzlon Energy, approx price 40 80, suggested amount 2,000 to 5,000, potential 3x, 8x, high risk. This is a high risk multi-bagger type stock. Number 3, railways infrastructure. RVNL, approx price 300 to 500, suggested amount 5,000 to 10,000, potential 2x to 5x. Government infrastructure spending is massive. Larsen and Toubro, approx price 3,000 to 4,000, suggested amount 10,000 plus, potential 2x to 3x. One of India's strongest long-term infrastructure companies. Number 4, manufacturing semiconductor theme. Dixon Technologies, approx price 8,000 to 14,000, suggested amount 5,000 to 10,000, potential 2x to 4x. India's electronics manufacturing boom may continue for years. Keynes Technology, approx price 2,500 to Frulls, 5,000, suggested amount 3,000 to 8,000, potential 3x to 5x, high growth but volatile. Number 5, Banking plus Financial Growth. State Bank of India, approx price 700 1,000, suggested amount 5,000 to 15,000, potential 2x 3x, strong for long-term India growth. HDFC Bank, approx price 1,400 to 2,000, suggested amount 5,000 Jegans, 10,000, potential stable compounding, safer than many growth stocks. Number 6, AI plus Digital plus IT, Persistent Systems, approx price 3,000 to 6,000, suggested amount 3,000 to 10,000, potential 2x 4x, benefiting from AI, cloud, enterprise digital transformation. Suggested portfolio by budget. If you have 25,000, stock amount HAL 5,000, Bell 3,000, Tata Power, RVNL 3,000, SBI 4,000, Dixon 4,000, Suzlon. Ahasher. If you have 1,000, category amount defense 25,000, power renewables 20,000, manufacturing semiconductors 20,000, railways infrastructure 15,000, banking 10,000, AIIT 10,000. While realistic expectations, a strong portfolio over 5 years could potentially become investment possible value 10,000, 20K, 50K, 50,000, 1LL, 3LL, 2L, 6LL. Very high returns usually require patience, holding through crashes, and avoiding panic selling. And most important rule, the biggest profits usually come from buying early, holding long, and staying invested while others panic. Most people lose money not because they choose bad stocks, but because they sell too early.
What would be my total investment?
Your total investment depends on how aggressively you want to invest and how many sectors you want exposure to. Here's a practical breakdown for a 5-year, one-time investment strategy. Level, total investment, type, beginner, 10,000 to 25,000, basic diversified portfolio. Serious growth, 50,000, strong long-term setup. Aggressive wealth building, 2.
If I invest in all the shares which we have mentioned above,
Here's an approximate total if you invest in all the shares I mentioned with a balanced long-term allocation. Stocks mentioned, stock suggested investment, HAL 15,000, Bharat Electronics 8,000, Tata Power 8,000, Suzlon Energy 5,000, RVNL Abro, Larsen and Toubro, Dixon Technologies 10,000, Keynes Technology 7,000, State Bank of India, 10,000. HDFC Bank, 8,000. Persistent Systems, 9,009 investment. Total suggested investment, approx total number Hassan 100,000. This is actually a very strong diversified future India portfolio because it covers defense, AI, banking, infrastructure, renewables, manufacturing, railways. Approximate number of shares you could buy. Prices change daily, so these are rough estimates. Stock, approx shares, hey hell, 3
What could be my profit overall? I have invested in Adani Power, few stocks. What could be its growth in future? And analyze the Adani Power chart and say me which month is best to invest and which month is best to sell the share.
Adani Power is currently one of the strongest momentum stocks in India's power sector, but it is also a high volatility stock. That means it can create very large profits, but also sharp corrections. Recent reports show Adani Power became India's most valuable power company after a major rally driven by rising electricity demand, strong earnings, and institutional buying. Hash growth outlook 2026 to 2031. Why Adani Power could grow strongly. India's future demand for electricity is enormous because of AI data centers, EV charging, manufacturing growth, rising middle class electricity usage, infrastructure expansion. Adani Power benefits because thermal power is still critical in India, power shortages increase merchant power prices, and the company is expanding generation capacity. Positive factors. Strong bullish drivers. India power demand rising fast, institutional investors increasing holdings, large capacity expansion plans, government infrastructure growth, Adani ecosystem expansion. Analysts and brokerages still maintain bullish views on the company. Risks you must know. Main risks: heavy debt, coal price fluctuations, political regulatory risks, very sharp corrections after rallies, Adani Group news sensitivity. Some market participants believe the stock can become overheated after parabolic rallies. Best strategy for Adani Power. For long-term investing, better to accumulate during corrections, not after huge green rallies. This stock usually behaves cyclically. 1. Sharp rally. 2. Sideways consolidation. Another breakout. Historically, better months to buy. No month guarantees profits, but historically, Indian markets often provide better accumulation opportunities during better buying periods. Why? June, July. Post-result corrections. September, market volatility. February, March, budget FII volatility. These periods often produce temporary dips. Historically, better months to sell. Better selling periods. October, December, festival bullish momentum. After strong quarterly rallies, momentum peaks. During euphoric news cycles, overvaluation risk. Practical strategy. Better than one-time buying. Instead of buying all at once, buy in 3-5 parts. Example, 25% now, 25% on 10% correction, 25% on panic selling, keep some cash reserve. This reduces risk. Possible future scenarios. Scenario, 5-year possibility. Weak cycle, 1.5x, strong India power boom, 3x to 5x. Exceptional infrastructure cycle, 6 plus. so minus 1 lakh could potentially become 3 to 5 lakh in a strong cycle. But volatility will be very high. Adani Power is stronger for long-term holding than short-term trading, best accumulated during fear, and suitable only if you can tolerate big fluctuation. If you invested 10,000 in Adani Power at 192, here's approximately what happened. Number of shares bought. Calculation 1,192 approx 52. You would own roughly 52 shares. Current value estimate. Adani Power has traded far above 192 in recent years. For example, share price, your investment value, 300, 15,600, 500, 26,000, 700, 36,400, 900, 46,800. Your profit potential. If the stock reaches future price, approx profit, 500, 16,000 profit, 700, 26,000 profit, 1,042 entry point was actually good. 192 is considered a relatively early accumulation zone compared to later rallies. That means your downside risk is lower than new buyers, and you already have a good margin of safety. What I would personally watch now. Bullish signs. India's electricity demand keeps rising. AI data centers need massive power.
As I have analyzed Adani Power share that last 2 years, from in June 2024, the share started falling to February 2025, and from March 2025, the stock raised till May 2025 and again started falling in June 2005 to February 2026 and again raised to May 2026. And upon going on, what could be the reason or what could be my analytes determine? And previous before 2024, please analyze the chart and provide me information which can be helpful for me to invest in this stock. Just basic, simple, easily understanding.
Your observation is actually very good. You are starting to think like a technical investor instead of just randomly buying stocks. What you noticed in Adani Power is called cyclical momentum pattern, meaning stock rises strongly, becomes overbought, people book profits, stock falls, institutions accumulate again, then another rally starts. That's very common in power stocks, commodity stocks, infrastructure stocks, and Adani stocks especially. What happened before 2024? 2020-2022, Adani Power had a massive rally because post-COVID recovery, electricity demand increased, coal power demand rose, retail investors rushed into Adani Group stocks. The stock became a multi-bagger. 2023 crash phase. Then came Hindenburg controversy, fear, panic selling, debt concerns. Adani stocks crashed heavily. This created huge volatility, emotional trading, strong fear in the market. What happened in 2024 to 2026? Your analysis is mostly correct. Pattern you observed, time, behavior, May-June, stock overheated, June-Feb, correction, consolidation, March-May, strong rally, repeat cycle, momentum rotation, and this happens because of main reasons behind the pattern. 1. Summer electricity demand. India consumes maximum power during March, April, May because AC usage rises, heat waves, factories consume more electricity. So power stocks often become bullish before summer. That's why rallies often begin around February, March. Number 2, profit booking. After big rallies. After strong rallies, traders sell, institutions book profits, stock cools down. That usually starts around June onwards. You noticed this correctly. Number 3. Monsoon weakness. During monsoon, electricity demand sometimes slows, cooling demand drops, power consumption reduces. This can weaken sentiment temporarily. Number 4. Adani stocks move emotionally. Adani stocks are heavily news-driven, things affecting movement, political news, court cases, foreign investor sentiment, debt concerns, expansion announcements. That's why technical analysis sometimes work less perfectly here compared to stable stocks. What your analysis means. Your observation suggests possible accumulation zone June, February. Often weaker movement, correction phase, sideways consolidation. This may become a better long-term buying zone. Possible momentum zone March, May. Often strong momentum, more demand, bullish sentiment. This may become stronger rally phase or partial profit booking opportunity. Simple strategy you can use. Instead of buy anytime, try phase strategy June, February. Slowly accumulate March, May, hold partial profit booking. This is not guaranteed, but your chart reading logic is reasonable. Most important technical things to watch. Bullish signs, higher highs, higher lows, volume increasing during rallies, stock holding above DDMA. Danger signs, huge vertical rally, RSI extremely high, sudden news-based spikes, very high public excitement. Those often lead to corrections. What big investors probably do, institutions often, buy during fear, accumulate during sideways periods, sell gradually into excitement. Retail investors usually
Can renewable power industry occupy the coal power industry, or there is very less chance?
renewable power will almost certainly become a major part of India's energy future, but it is unlikely to completely replace traditional power, especially thermal power, within the next 10 to 20 years. The real future is probably hybrid power economy, meaning renewables grow very fast, but coal, gas, hydro, and nuclear still remain important. Why renewable energy will grow strongly. India has huge pressure to reduce pollution, reduce oil coal imports, meet climate targets, support EVs and AI infrastructure. The government is investing heavily in solar, wind, battery storage, green hydrogen. That's why renewable companies have strong long-term potential. Examples: Tata Power, Suzlon Energy, Adani Green Energy. But why thermal power still survives? This is the important reality many beginners miss. Solar and wind are not always stable. Problems: no sunlight at night, weak winds sometimes, seasonal variation, battery storage still expensive. India needs 24/7 electricity, stable grid power, industrial reliability. That's why thermal power still acts as the baseload backup. Hack what modern society needs. Future society needs massive electricity, continuous power.
What would be the top 10 best stocks for investment in renewable and thermo energy? What about NTPC Green? As per today's situation, is it can grow or fall down? Please give me the fact, not the ideology of NTPC, the main company. I want to know about NTPC Green, not NTPC. If I start rupees 1000 SIP in NTPC Green, do I be profitable for approx 10 years? If I invest 1,20,000 today in NTPC Green, what would be my return in 2000 or what would be my return after 10 years? Best way to earn online. part time, but not coding. I am not from IT field.